We're continuing with Chapter 2 in our personal financial statements. As we talk about that at the beginning of every chapter, of course, is the chapter objectives. And what I want to do is just cover a few items that are covered in the chapter, really beginning and talking about personal cash flow statements. Now, a personal cash flow statement, as you see the example here of Stephanie herself, is a financial statement that measures a person's cash inflows and their cash outflows. Cash inflows include those things like salaries and interest, dividends, anything that's a positive cash income. Cash outflows are all the expenses that are incurred, whether large expenses or small expenses. And what you do is you create a statement by recording your revenues and expenses over a period of time. For example, she has done it for a month here. And the net cash flow is what your excess of cash inflow is over cash outflow, or conversely, it's the cash inflows if there are less than cash outflows, which isn't a very good position to be in. What are some factors that affect cash inflows? Well, obviously, where you are in your career path is going to affect your cash inflow. If you are new in a career path, you're probably going to have a lower salary than somebody who has been in a career path for quite a long period of time. If you're in college, you probably have different cash flows than if you're approaching retirement. The type of job, of course, is going to affect your cash flow. Based upon what your skill level is, the demand for those skills, the number of income earners in your household is going to affect your total household cash flow. Other factors that obviously could affect cash flow with how many kids you have, the size of your family, what age you are, what your personal consumption behavior is. Some people spend all their income and more, while others really are much more frugal and they spend only on necessities and they concentrate on saving for the future. So let's talk about cash inflows and taking that concept and really creating a personal budget. You see here that Stephanie has taken her cash inflows. The first column just represents what she has identified as her actual, and she has now created a budget for the future, what her expected amounts are for the future. And she has put in adjustments with respect to those items that are anticipated to come along. If you have small shortages, those can usually be made up through your checking account. But if you have large shortages, quite often you may rely on credit, or you may rely on savings or some other vehicle to help to make up those shortages. One of the important things of whenever you're going through and creating a budget, of course, is always being in a position to assess the accuracy of your budget. And this is just comparing what you predicted for cash flows and comparing them to what they actually were. And then that allows you to make adjustments as necessary. And once you begin to understand what your own personal cash flow is, you can then begin to extend that forecast, that budget out even farther into the future. And you can start to extend over the next several months, and you use that information to start to take into account what may be items that are either unanticipated or items that you can't anticipate. For example, as you approach the Christmas season, you may have to factor in that you're going to have some seasonal shopping expenses that need to impact your budget. And as you go through and you start to get a better understanding as to what your normal cycle and your normal pattern of spending is, you can become more and more accurate on creating a budget. And then once you've really kind of started to zero in and hone in on a month's, maybe a quarter of a budget, then you can use that to forecast out for an entire year, and you can create a budget itself. And then improving the budget is something that you always want to do. You always want to take, here's what I anticipated, here's what I actually experienced. What is it now that I need to learn from that and to take into account into the future? Now, just a couple things about just being ethical about a budget process, especially for those who are college students. Do not just continue to build your budget where you're going to rely upon your parents or a dependent upon somebody else. Say, well, I'm just going to have shortfalls and they're going to make it up. They always have. Is start to learn what it means to live within a budget, to live within your means. In other words, be honest and be true to yourself about creating a budget that you are going to work, and work hard at staying within that budget. Now, I want to talk about, when we talk about personal financial statements, is just the concept of a personal balance sheet. You can see here on the budget that the example I show is that she has just kind of worked in the forecasting errors of what she budgeted versus what she actually had. But let's talk about a personal balance sheet. A personal balance sheet is really just a summary of what you own, what are called assets, and a summary of what you owe, which are called liabilities. And a person's net worth is just the difference between what you have and what you owe, and the difference becomes your net worth. And that balance sheet reflects your financial position at a specific point in time. For example, you go out and you say, all right, at December 31st or on March 15th or whatever it is, how much do I own? How much do I owe? That's what my net worth is for that one particular date. So as you go through and you start to pull together a personal balance sheet, you can see here Stephanie has an example of a personal balance sheet. And I want to talk through just a few of the component pieces that you see here. The first component piece are what are called liquid assets. Liquid assets are those assets that are either cash or can be easily converted to cash without a loss in value. In other words, a checking account isn't cash per se, but is something that you can go and you can, in essence, convert that to cash without any loss in value. Same with the savings account. Household assets are those things that are normally owned, with a home, car, furniture, some of those kinds of things. Stephanie's example here, obviously, is she's a renter because she has no home on here. But what you should put in household assets is, in essence, what is called fair value. This is what you could, if you were to sell that asset and convert it to cash, this is what you would receive in cash. And, for example, on your home, you don't want to put just the resale value on a home. You want to put what you would net out of your home, including real estate fees and any other expenses, fixing up expenses, those kinds of things, so that you can have this. You can have a clear picture of this exactly is what I could get if I had to liquidate, if I had to sell everything to get cash. That includes your car. You may have bought your car for $20,000, but it's only worth $1,000. You may still owe $15,000 on it, but if you were to sell it, you would still only get $1,000. You put down the $1,000 of what you could get for that. You may also put down things such as real estate holdings or other kinds of things, which may be included in a different category called investment assets. Investment assets are those things like stocks or bonds or real estate that you are holding for a very particular reason to get returns on those things. Liabilities, which is the other side of the balance sheet, for if you remember from your basic accounting. Liabilities are those things that you owe. Current liabilities means everything that you owe within the next 12 months. And the reason that is important to separate that from long-term liabilities, which is everything that is owed after in 12 months or longer, is you want to understand what your current liquidity position is always and keep your finger on the pulse of that. For example, if you had cash or easily converted cash items, current assets of $500, but you had current liabilities of $10,000, that's telling you that over the next year, right now, you only have $500 to pay $10,000 worth of bills. And that's not a good position to be in. That tells you that I need to change something in my liquidity. Either I need to sell some assets so I can get more cash, or I need to look at doing something with my liabilities to change them into a longer term type aspect. And net worth obviously is the difference between the two. And you can see here in Stephanie's example, she really doesn't owe that much. But once you start to once you start to get older, you start to buy cars and get mortgages, buy houses, do all those kinds of things. Those kinds of numbers really start to change rather dramatically. When you create a personal balance sheet, it always allows you just as a snapshot to see where your net worth is at any point in time. When you look at changes in your personal balance sheet, as you kind of look from what it used to be to what it is now, it really allows you to be able to see what is going on. And you can always, this is something that you should always consider whenever you're looking at making a significant purchase, such as a new car or even a house itself. And as you start to go through here, you start to understand how there are certain factors that are part of the environment you operate within that impact your personal balance sheet. For example, the economy impacts your personal balance sheet. Because if the economy is favorable, if there's favorable economic conditions out there, that can increase your job opportunities. That may increase your income potential. But conversely, if there are unfavorable economic conditions out there, that can result in lost jobs. That can result in income reduction. So your net worth can decline to the point of becoming negative, becoming a real problem. And that's how come it's important to understand the whole concept of cash flow and how cash flows affect the balance sheet. Because when you look at cash flows itself, when cash is positive, when you have net cash flows coming in, which is your inflows exceed your outflows, you can use those dollars to invest in more assets. Hopefully those assets that will increase in value over time. You can use those dollars to reduce your liabilities so that over time, as your value of your assets increase and your liabilities are decreasing, your net worth, your net wealth is going to be increasing itself. Now, if you just use cash just to pay down a current liability, you notice what happens on the balance sheet. Your assets decrease and your liabilities decrease, both by the same dollar amount, which means your net worth hasn't changed. But it also then positions you to not necessarily be affected as much by some things like economic condition. When you have a personal balance sheet, obviously it allows you to monitor your liquidity, monitor your debt, monitor your ability to save. And liquidity, when we talk about liquidity, that is just a term that is you will hear quite a bit throughout this course. And liquidity is measured, whether it's personally or in a business itself, by something called the liquidity ratio. And you will see this in your book as you go through and look at this. Liquidity ratio is merely current assets divided by current liabilities. And so you look at that and you start to recognize, if I have current assets of 4,000 and I have current liabilities of 2,000, that gives me a liquidity ratio of 2. 4,000 divided by 2,000. That means that for every dollar, every $2 I have of assets, I can pay down $1 of liability, or I've got $1 of liability is offset by $2 of assets. The higher the liquidity ratio, as that number goes up, the greater liquidity a person has. Conversely, you can also look at what is called a debt-to-asset ratio. And a debt-to-asset ratio is taking your total liabilities divided by your total assets. You do that from the personal balance sheet. And so our example with Stephanie's balance sheet was that she had liabilities of $2,000. She had assets of $9,000. That gives her a debt-to-asset ratio of 22.22%. The higher the ratio, the higher the debt is related to assets. So if you get up to a 1-to-1 ratio itself, you start to recognize that I have no net worth. Because if I have $10,000 in assets and $10,000 in liabilities, that ratio is 100% or 1.0. there's no net worth there. So obviously you want to decrease over time your debt to asset ratio itself to get healthy. As you look at this whole concept of budgeting and how budgeting fits into your personal financial plan, as you dig into this chapter, it's going to be really asking questions like, how can I improve my net cash flows in the near future? How can I improve my net cash flows even farther out into the future?